Welcome back to the channel. I'm Ozbourne Foreman, and today I'm going to be discussing an investment strategy which is the do nothing advantage. Now, you might already be miffed at what I mean by this, but don't worry, I'm going to go into great detail on how this strategy differs to conventional manners of investing and what really can be done. What practical steps can investors take to implement the do nothing advantage in their own portfolios? So if you like this video, then drop one of these, as it is much appreciated. First and foremost, we're going to be looking into an article here, and this is one on ASOS. And I'll link back to the do nothing approach from this. And it says, ASOS, fast fashion groups fall out of fashion fast. A nice little play on words there. Green is out and red is in for followers of online fast fashion as the appropriate colour to track falling stock prices on trading screens. The industry thrived at the height of the pandemic that created a large captive customer base. Shoppers now buy fewer clothes online. They are returning more of their purchases too, pushing up costs for retailers. Competition remains ferocious. New entrants such as the Chinese disruptor Shein and second-hand clothes vendor Vinted are putting pressure on incumbents. These include ASOS of the UK, an industry pioneer. Its shares have lost more than 90% of their value since peaking in March 2021. Boohoo of the UK and Germany's Zalando have also fallen. And there's a chart here that shows ASOS's sales and their gross margin over time. So as their sales had increased historically, their gross margin had actually fallen, which would imply here that perhaps they were obviously selling more discounted goods and clothing. They were pushing a lower value transaction to encourage greater levels of sales. By doing that, they might have seen a higher level of profits due to the volume approach that Boohoo has, but they've now done some changes that they've implemented, which we'll discuss in a second here. And it says here, fast fashion flops. You can see the Stocks Europe 600 index, which is up over the last 2 years by about 20%, which it all starts at 100, obviously. Boohoo, ASOS, Zalando are down significantly. It says here, ASOS showed few signs of improvements in the half-year results this week. Sales declined in the UK accelerated to 15% year-on-year. The company made an operating loss of £272 million. Shareholders were spooked. Shares fell on the day to trade at 10 times forecast 2024 earnings. Don't think that's particularly too relevant. Investors should view online fast fashion retailers in the same light as the garments they sell. Fun, flimsy, and ethereal. I can't say that properly. Big banks have franchises that can last for several centuries. I'm not sure where they're going with this. Physical garment retailers typically have shorter shelf lives. Marks & Spencer was set up in 1884, but its clothing business has been in decline since the 90s. Life cycles are even tighter in online-only fast fashion. That is because barriers to entry are so low. Businesses need no special intellectual property, only modest physical infrastructure is required. Contractors make the clothes. And it says here, consumers have little brand loyalty. They want the quick wish fulfillment at rock bottom costs. Now it talks about ASOS here, and what they're trying to do is rebuild ASOS as a smaller, leaner, and more profitable business. The golden rule in retailing is to maintain gross margin, so that means passing on any rises in supply costs to customers. But this is hard to do under competitive pressure, even more so to the extreme of Boohoo, that is a volume-based business that has seen obviously these inflationary pressures on their goods, but if they rise prices, then they're going to lose a significant amount of sales as they are the value orientated consumer. Now, I discussed this quite a lot on my ABF Stockwatch report, which is on my Patreon, so if you haven't seen that, definitely check that out. And this is hard to do under competitive pressure. So ASOS's gross margins has slipped from 50% in 2019 to 40% in the year to February. Now, ASOS hopes to repair the damage by getting a better grip on its supply chain. It's written down a chunk of inventory and plans to carry less stock. The broader turnaround plan is supposed to add some £300 million of annual benefits. Calamonte, the CEO, aims to squeeze a proportion of ASOS's customer base who are more trouble than they are worth. They mainly buy discounted clothes, returning a large percentage of them. The purge should have the effect of reducing sales without a serious impact on margins. Most indicators such as order numbers, active customers, and site visitors are moving in the wrong direction. Shareholders are concerned they may be tapped for more cash. Funds are tight. ASOS drew down £250 million of funding facilities, leaving cash and facilities of some £400 million as of February. Cash inflows in the second half should result in a cash burn of £100 million for the full year. Shareholders in ASOS had a great run during its years of growth, but it is now a troubled incumbent rather than a plucky disruptor. Risking capital on a reboot would be unwise given the fickleness of the fast fashion industry. So you might go, okay, great, Oz, you've now read an article, but how does this relate to the do-nothing approach? What really matters here, and why is this different to conventional strategies? Well, there's a lot of bad news here, right? This isn't promising overall for ASOS. The way this article is, it's kind of encouraging you that if you're holding shares of ASOS, it's not looking good, there's not going to be a good return here, so perhaps you should look elsewhere, you should sell your money and run for the hills. Now, arguably, you could say the approach of cutting your losses and remaining disciplined in your investment portfolio is a good strategy for the longer term. At the same time, you could also argue doing the opposite. You could say, well, actually, ASOS is really beaten up right now and times are struggling. Well, actually, though, things look promising for the future. So perhaps I should buy right now. What the do-nothing approach to investing here is going, well, at the end of the day, do you have to actually invest money into this company? There are plenty of opportunities available. Is it right now that this is needed? Now, obviously, shares have dropped by about 30% in the last month for ASOS alone, so it is now the opportunity, is now the time to be buying more. So by doing nothing, you can go here and go, well, actually, I can see the shares are down, but there's no harm. I'm not going to go bust if I don't buy anything. If anything, I'm just building up my liquidity. By holding more cash in the portfolio, I am now more resilient. I'm more agile, and it means I can react to market trends if I should need to. And this kind of relates to my own holding with Boohoo. And the reason the do-nothing approach challenges traditional investment beliefs and practices is that people always preach the idea of, oh, you've got to be buying and selling. You've got to buy when it's low and sell when it's high. But by doing nothing and setting up correctly, you could have a very disciplined but long-term gaining approach. Now, ASOS is a good example here because ASOS and Boohoo are companies without wide moats. My mistake, personally, was purchasing Boohoo in the first place, which is easy to say in hindsight, right? Very easy to say, and I bought a very high valuation. Now, Boohoo is a business with a limited moat, whereas we could contrast that to a business like Legal & General. Well, Legal & General is a large UK insurer, and they also own a house builder called Calla Homes, which is based in Edinburgh. Now, the point I'm making here is that many people or many businesses can compete and enter into the fast fashion industry, but it is significantly more challenging for companies to start up their own house building firm or even become an insurer, like the level of depth it would require to that. So by saying, okay, you know what, I've identified some quality companies, and then going with the approach of, do I actually need to be buying more shares of this stock? Or alternatively, I've found a good company, I've bought some up front, I'm going to hold fire for a bit. I'm going to see how things go. By sitting there, you go against a lot of investment beliefs and practices. A lot of them that are saying, oh, you should be always buying, dollar cost average, do this, do that. Not really. And if you want a little bit more depth on Legal & General, I've got a 15-page report on my Patreon that says Unveiling Legal & General, a lucrative dividend investment in the UK insurance industry. I go into great depth about the business model, their competitors, their risk analysis, but mainly, is the dividend worth it for investors, summarizing the good, the bad, and the ugly. If you like that, there's a link in the description down below to go check it out. So, what are the potential benefits of adopting a do-nothing approach or mindset in investing? Well, if anything, you're more relaxed. You've reduced your emotional exposure to the investment portfolio. A lot of people will keep looking at their investment portfolio and they'll see the red and they'll react with negativity. It's triggered that emotion. Oh no, I've just lost £100 in the last hour. That sucks. As humans, our core nature is to avoid losses. And you could argue the other hand of the coin as well and say, well, yes, I've seen 50 quid rise in profits. Fantastic. But ultimately, you're going to be more impacted by the losses that you have. But removing that emotional basis and saying, you know what? I've bought 5 or 6 quality companies. And what I'll do is I'll sit. Okay, well, yeah, Calnex has recently had a poor trading update, which suggests that going forward, the cash flow of the business will decrease. They'll still remain profitable because the telecommunications industry has had less investment. Okay, shares have dropped by 33% in the last few months. This could be a valuable buying opportunity. At the same time, though, you don't have to buy. That's the beauty of it. You could sit there and remain disciplined in your approach and go, well, actually, I don't need to buy. Of course, obviously, it's always about scanning opportunities, but by default saying, I'm not going to do anything yet, and then really thoroughly conduct research on the company, really analyze its strengths, its advantages, and chances are, by doing nothing, you might go, but what if I miss the bottom? You might not. You might end up like in my portfolio where my shares have declined over and over. My portfolio has a value of £23,165. We draw our eyes to Boohoo here, and you'll see the trend in the graph. Over the last month, they're down 25%, but if we go over the last year, they are down 50%. You could have thought that here in July was a dip, and it might have rallied a little bit, just to find out that actually in September there was another dip. That's the point I'm making, the do-nothing approach. But I also believe that inaction can also lead to poor portfolio returns. By not doing anything at all as well, on the contrary, this inaction could lead to financial distraught because you've got to do the analysis up front. You've got to identify, is this a good quality company? And then reevaluate as things change. Okay, ASOS has had a poor trading update. Is there a trend in the industry? Is there a problem here? Is there a fundamental issue with the reason I purchased this stock? Or, alternatively, is this shared by the competitors in the industry? Are the management making long-term cash generative decisions that mean that overall, over time, you'd expect profits to return to the company and let's say a good value on these shares? Inaction in this case, where I'm just watching Boohoo drop down, is in a way a bad thing. And this is why I say do nothing. I'm not saying be inactive. I'm saying do nothing. You could argue that I could be buying on the way down. I could significantly lower my average and have even greater capital losses than I already have of £17,450. Yes, of course, I could keep buying down. And what if it goes back up? But my approach is just now to sit here and go, I'm not going to do anything. If, of course, the trading update that Boohoo releases is more positive, and that, you know what, there's a good trend here. It's going, actually, there's a good promising outlook for the company. Volumes are recovering, and actually people are returning less clothing. Well, great. Is that expected? Who knows? It's probably likely that returns of a higher rate are going to continue as a trend in the industry. That's the way the business model is. But there's nothing to say they can't grow volumes back. And so, I'm kind of at the point here, with Boohoo in particular, is, okay, if they have a very bad trading update, where actually there's no future outlook for the long-term success of the company, and things are looking negative, sure, my shares might be down 80% at that point, but I'll cut my losses and I'll take out 4K, whatever's left in that position, and mark it up. That's fine. And truth be told, perhaps I've left it too late. Perhaps by doing nothing here, this inaction has actually led to financial unsuccessfulness, financial distraught in this time. But I do believe that majority of the time, by being inactive, it can have a greater peace of mind. And with that greater peace of mind, I think you can find long-term financial success. Again, if I was really focused on the dip of Boohoo as it's going down over time and only concentrating on that, I'm not going to have a great peace of mind, and I'll probably be chasing this loss, and I'll be trying to buy more and buy more. Arguably, the best investor probably would have cut their losses in August when they had a trading update and went, okay, you know what, things aren't looking too good. But for me, I don't think much has really changed in the company in the last year or so, or maybe 2 years at this point, and I think actually the longer-term outlook remains consistent. Of course, it hasn't gotten better, but it's just remained the same. But the share price has changed, so I think there's an opportunity there in buying some value. So what practical steps can investors take to implement the do-nothing advantage in their own portfolios? What can we do as investors, or what can't we do to do nothing, right? Simply put, if I were to just chuck in some money in my portfolio every single month or as frequently as I'm paid, leave that money in cash, and simply just not watch the share prices. Read the trading updates for the companies that you follow, read the annual reports, and go, actually, I'm reading Mastercard's annual report at the moment. I think this is promising. I think the only big competitor to Mastercard is cash, and cash isn't fighting back. There's a huge advantage there. I'm now more interested in the business. By reading the trading updates first, by reading, let's say, articles on the company, you can come to your own conclusion devout of share price. By implementing that step of just reading the trading updates and not following the share price itself, you can then go, okay, I'm interested in Legal & General again. I think they've got a very good dividend yield. I think they've only got a payout ratio of 51%. The business model is agile. They have plenty of capital and they are more than able to succeed. Well, okay, I like the business. I've gone through 15 pages of this Stockwatch report, which is on my Patreon, and gone, okay, I'm going to buy some shares of Legal & General. What's the valuation? What's the current share price? Is this a fair valuation? By then doing that, almost last, by doing nothing in that approach, not having to buy right now, I think this is a huge advantage in your portfolio for the longer term. I appreciate that this has probably been quite a confusing video, but by doing nothing, I think really you could outperform the market average. And I think that's the goal that we have as investors, right? To get a better return than the S&P 500 on average, which is an incredibly challenging feat to beat. And a lot of people have given up in advance of that. They give up because they're like, well, you can't beat the market because 80% of people can't. Well, what's to say you're not that 20% that can? If you put enough time, effort, and energy in and you really study, you try and learn from your own mistakes, you take an approach of doing nothing where it might matter, then you might do better over the longer term. Why conform to the average and go, you know what, I'm going to just be average? And this applies to life as well. Like, why do you want to be average? You want to be there, you want to have 2.1 kids and a dog, and that's it. You're happy, you're obese because the average person over the age of 30 is obese, apparently now these days, especially in America. It's like, why would you want that? Why not strive to be better, become the best version of yourself? That's truly key. So thank you for watching this one. I have been a bit more experimental on this type of content. I hope you enjoyed it and have a fantastic day. If you haven't already, definitely click that subscribe button down below. Peace.